Good day, everyone. My name remains Miss Blessing, your financial accounting and finance tutor. Thank you for the comments. Thank you for the likes. Thank you for sharing. And thank you for those of you asking questions. A wise one said, those who ask questions don't misread. Me and you will not misread by the grace of God. And now, at this point, we know what accounting is. What is an account? What is bookkeeping? We know who is an accountant. We know the difference between accounting and bookkeeping. We know the users of financial statement at this point. Yes, we know our two rules: debit the receiver and credit the giver. Debit the receiver and credit the giver. And we know the principle of accounting that says for every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. In a nutshell, if there is a giver, there must be a receiver. And if there is a receiver, there must be a giver. That is just the simplest method of accounting. There must be a giver and there must be a receiver. That is the rules. Debit the receiver and credit the giver. For example, sales goods, 5 naira. Sales goods, 5 naira by cash. Sales, remember the rules: debit the receiver, credit the giver. What does that mean? He who receives should be debited. Who gives should be credited. He who receives should be debited. He who gives money, if you gives out money, credit you. If you receive something, debit you. Simple. Sells goods, 5 naira by cash. Sales, when you want to sell, are you receiving something or are you giving out? When you want to sell, you give out. Is that correct? Sell by cash, right? Sell by cash. What do you mean? When you sell by cash, you receive cash. The two account that is involved is sales. Because it is goods, the name of the goods is not stated. We'll put sales and cash. Do you understand? Sales and cash. And the rule says debit the receiver, credit the giver. You sell, you give. By cash, you receive cash. So we open sales account and cash account. You sell, you give out. How much? 5 naira. The description is by cash. 5 naira. Cash, we receive cash when we sell. 5 naira. That is just the rules. Debit who receive, you receive cash and sell goods. You give out goods. So you credit your sales and debit your cash. As simple as that. That is why don't forget the principle. For every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. In a nutshell, it does mean that if there's a receiver, there's a giver. That's all. And if there's a giver, there must be a receiver. It's only a madman that made transaction by himself and said, hey, hello, Blessing. How are you, Blessing? Then we'll know something's wrong with you, right? So that is just the basic rules of bookkeeping. And remember, don't forget, the founder of accounting, in case you are asked, remember I told you last time that accounting itself is as old as man. It began even before men began. Is that okay? And it begins in Babylonian, 15th century. Do you get? It began 2,000 years ago, even before Christ. And the father of accounting is what? is Father Luca Paciolo. In 1494, he published the first double entering principle. Is that okay? He published the first double entering principle, these articles, and he named it Summa de Arithmetica Geometric Proportion et Proportionalita. I repeat it, he named that double entry, he published his work and he named it Summa de Arithmetica Geometric Proportion ex Proportionalita. That was the name of his work, his first publication, his first work on double entering. So in case you are asked, who is the father of accounting? Is Father Luca Paciolo, and he found it in what his first publication was in 1494, before even and other professional bodies start coming up in Nigeria, like ICANN, the ANAN, and so on. Is that okay? So without wasting much of our time, we know the rules of double entry and we know the principle at this point. Don't worry, we'll be doing more of calculation, but now I'm still just summarizing few things so that we will get to know what is this accounting all about. What is it all about? Is that okay? So let's look at the branches of accounting. The branches of accounting. We have three basic branches of accounting. Do you understand? We have three branches of accounting. We have the financial accounting, we have the financial accounting, we have the cost accounting, then we have the management accounting. Is that okay? The financial accounting, this is one of the branches of accounting that deals with what? The preparation of financial statement for decision, preparation of financial statement, I beg your pardon, and for what? For outsiders like our debtors, our creditors, financiers, financial analysts, even institutions. Is that okay? So financial accounting is that branch of accounting that's really the preparation of financial statement and for what? For outsiders. Examples: debtors, creditors, financial institutions, and other financial housing. Why this cost accounting? The cost accounting is a branch of accounting that deals with ascertaining the what? The cost of a product and help management in what? Decision making, in cost reduction. Understand? It help management to what? To identify its cost and reduce cost. It's the branch of accounting that deals with the ascertainment of the cost of a product. You understand? And help management to what? Determine its cost and also reduce cost. Is that okay? Then management accounting is the branch of accounting that deals with what? Planning, controlling, and decision making. Its own accounting is just that branch, that small branch of accounting that deals with planning, controlling, and what? Decision making. These are the three basic of accounting. Financial branch of accounting, I beg your pardon, branches of accounting. We have three basic branch of accounting. Financial accounting, which deals with what? Preparing financial statement. The cost accounting, which helps to what? Ascertain what? Cost of a product. And the management accounting deals with planning, controlling, and decision making. Am I understood? So I will round it up this time with our what? Accounting equations. Accounting equations. Now, these accounting equations, it is the fundamental framework in which account revolves. Accounting equation, I repeat, is that framework that governs accounting. It revolves around accounting. There are three basic equations. We have our assets, we have our liability, capital and liabilities. So these are the basic equation of accounting. That is what accounting, that is what governs accounting itself. Assets, capital, and liabilities. Remember in our previous class, I told you what an asset is. I said anything an organization can control, anything that has monetary values, which an organization, an individual can control, has control over, is your asset. I told you example of an asset, what's it called? Land, building, goodwill. Those are your assets. Remember, you have control over them. An asset comprises of what? Capital plus liabilities. Capital plus liabilities. Capital plus liabilities. Let me do it so that you can see it very well. Do you get what is capital? Asset is capital plus liability. What is this capital? Now, capital is what, and let me use it in a layman, what we use to start a business. A capital is what we use to start up a business. That is your capital. Liabilities is what we own to outsiders. An example of liability is loan, creditors. Somebody asked me, asset, if you say asset is net worth of a business, if you say asset is a monetary value, how come it's liability, what we own to outsiders, is also an asset? Now listen, remember what I said in our previous time. Asset is anything that with monetary values that an entity or an individual can control. Loan, when you loan money in a bank, are they going to give you that loan money, or they are not going? After filling all the requirements or for you to be given a loan, they will give you. And remember the rules, debit the receiver. And when money, you borrow 50 million and you have capital of 50 million, is it reducing or is it increasing? So automatically, if you borrow 50 million and have 50 million, it becomes an asset to you. Did you understand? Now, how about creditor? What creditors are what we own to outsiders, your suppliers. Did you get? So if your supplier supply you goods, you are here to pay. Remember, it's a liability, right? But it is stopping up your business. So that is why asset is capital plus liabilities. Then we have our what? Capital. And capital is assets minus liabilities. Assets minus liabilities. Why is this so? Remember, we say capital is what we use to start up a business. The total asset, we remove what we want, what we borrow, what we own to outsiders, is your capital. Asset, the total of your business, that is capital plus liability. The total of your business, excluding what you own to outsiders, is your capital. Is that okay? Then we have liabilities.